Please remember this information is general in nature and doesn't take into account your own situation. The next question is also from Carlo. When a superannuation fund enters the pension phase, all investment earnings become tax-free on both the taxable and tax-free components. Are these tax-free earnings allocated to the tax-free and taxable components in the same proportion as the existing balance? Or are all tax-free earnings added solely to the tax-free component?
Yes, again, a really good question, Carlo, and I thank you for asking it. And this is where superannuation rules become a little bit complicated, but it's not too hard to get our head around. We know that our super is broken up into two main components or tax components. That's the tax-free component. The tax-free component is made up of all of our personal non-concessional contributions. It includes spouse contributions, and it includes earnings in pension phase. I'll come back to that in a second. Then we've got our taxable component, which is your employer super guarantee, your salary sacrifice contributions, etc., and all earnings in accumulation phase go that way. So tax-free and taxable are two main tax components of each member's balances. Now, when we look at the earnings on our fund, the fund earnings, they get treated differently depending on if we're in pension phase or not. If we're in the growth phase of super, we're working, we're making contributions, we're in accumulation phase, any return, any interest, any fund earnings will always be allocated to the member's taxable component. So if you're in accumulation phase, earnings always go to the taxable component, not the tax-free. The tax-free component is essentially what's left over after we've determined the taxable component. So it's just the non-concessional contributions, what I went through before. But when we're in pension phase, the earnings, the fund earnings, get allocated to both the taxable and the tax-free proportionately. When we start a pension, we say, hey, trustees, I want to start a pension with $1 million. We determine what the tax components are. There's some tax-free component and there's some taxable component. So let's just say that Toby has a $200,000 member accumulation balance made up of $150,000 taxable and $50,000 tax-free. On that $200,000, the fund earns $20,000 earnings for the financial year. Now, because Toby is 100% in accumulation phase or entirely in accumulation phase, those $20,000 in earnings are allocated all to the taxable component. At the end of the year, Toby's got the $200,000 plus the 20 earnings, $220,000, broken up into $170,000 taxable and $50,000 tax-free. All of those earnings have gone to the taxable component because Toby was in accumulation phase. Now, let's change that. Toby has $200,000 in a pension, and it's again the same components, $150,000 taxable and $50,000 tax-free. To make our minds work or make life easy here, the $150,000 taxable component represents 75% of his member balance of $200,000. Again, the pension earns $20,000 for the financial year, and those earnings are allocated proportionally to the taxable and tax-free. So 75% of the earnings go to the taxable component and 25% of those earnings go to the tax-free component. The way I explain this in an easier way is that once you start a pension, you create fixed tax components, taxable and tax-free. Those fixed percentages will remain for the life of the pension, hence why those earnings get allocated that way. Hope that makes some sense. If you want to know more about the proportioning rules, there is, as I said, a good article on what they are and why those proportioning rules actually matter.